Hi, welcome to my channel. My name is Venkatesh. I upload content relating to the subject areas of accounting, business and economics. In today's video, we are going to be looking at part 5, basics of accounting. So let us start today's video by trying to understand what are the various classification of items that you can do towards personal account, real accounts and nominal accounts. So I have a few examples here that you can look at. There are around 11 examples that we can pay attention to understand what each of these accounts are. Are they an asset? Are they a liability? Are they capital? Are they expense? Or are they revenue? And whether they fall under the criteria of real, nominal or personal accounts. So you have 11 items here, starting off with stationery account, which is by default an asset because it's a real account, because stationery is an asset in the organization, something that you would use probably in your business operations. Then you have depreciation account, which is an expense. Like if you remember part 3 basics of accounting video, I explained to you what depreciation was. It is an expense which reduces the value of an asset over a period of time. So since it reduces the value of an asset, it is an expense. So hence expenses and revenues by nature are nominal accounts. And then you have cash account, which is an asset because cash is a real asset that you use in the business. You use it in the day-to-day operations. So hence all assets are real accounts. And then you have bank account, which is similar to cash account. It is also an asset in the business. You use it for the day-to-day operations. You deposit money in the bank account for future uses, or you have a bank account which you use for majority of your operations. So hence bank account is also an asset. Hence it is a real account. Then you have goodwill account. Goodwill is basically the reputation of a business which has been taken into account. So hence goodwill gives a lot of monetary value to the business. Goodwill becomes an asset to the organization. So hence goodwill account is an asset. So hence all assets are real accounts. And then you have interest account. Now since it is not mentioned whether it is interest earned or interest paid, by default we are going to assume it as nominal account because both expense or revenue are considered to be nominal accounts as part of the golden rules of accounting. And then you have patents and trademarks account. These are intellectual properties. So you do not have a specific material method of identifying them, but it is an idea or it is an intellectual right of the organization to have this. It could be a process, it could be a methodology, or even it could be something that has been unique and has been figured out by the business organization. So since they will be using this in their day-to-day operations, or probably they will be using this in the future business requirements, so patents and trademarks are an asset in the business. So hence all assets are real accounts. And then you have capital account, which is, like it states, capital that you require in the operations of the business which you use. So when you contribute capital into the business, it becomes a personal account because the owner is the one who contributes capital for the business. And then you have bank loan account. As the name itself states, bank loan account speaks about liability because you have taken a loan. So hence all liabilities are personal accounts. And then you have rent account, very similar to interest account. It is not mentioned whether you have paid rent or whether you have received rent. So we are just going to assume it as either an expense or revenue, but it is a nominal account because all expenses and revenues are nominal accounts. And then you have Kumar's account, who is a customer, which has been mentioned in the bracket. So we assume Kumar to be a customer in the business. So hence any person who has a name or any entity which has been recorded by its name becomes a personal account by default. It could be a customer, it could be a debtor, it could even be a creditor or anything for that matter. If you're going to use a person or an entity's name, by default that account becomes personal account in the business. To continue with, let us understand a few more examples as to how to classify an account. So you have 8 items which are mentioned here, which are purchasing typewriters, acquiring trademarks, paying salaries, acquiring a lease of land for 10 years, paying interest, purchasing furniture, paying compensation to workers, and theft by burglars. So let us try to understand what each of these items are and how do you classify them. So basically when you're purchasing a typewriter, it is an asset because you're going to use typewriter in the business. So all assets are real accounts. Then you have acquiring trademarks, which you're going to use as part of your business. So you're going to put a trademark for any product or service that you're going to provide, or you're going to label a trademark in any one of your products in the packaging. So when you're going to use a trademark, it becomes an asset. So hence it's a real account. And then you have paying salaries, which is clearly nothing but paying a particular compensation for your employees who have been working in your organization. So hence it is an expense. And then you have acquiring a lease of land for 10 years. If you're going to acquire a lease of land for 10 years, it is most probably going to be a liability liability, so it could definitely be classified either as a liability or an expense depending on how you have been acquiring this particular piece of land. And then you have paying interest. So here it is clearly stated that you are the one who is paying the interest in the business, so you're paying it to someone to whom it was due, so hence paying interest becomes an expense as part of the business. And then you have purchasing furniture. Furniture is by default a fixed asset that you will be using in your day-to-day operations in the business, so hence purchasing furniture is an asset. And then you have paying compensation to workers, very similar to paying salaries as mentioned in the third point. So when you're paying compensation to your workers, it could be in the form of wages, it could be in the form of salaries. So hence it is an expense in the organization because you are the one making the payment. And then finally you have theft by burglars, which is nothing but someone coming into your business, stealing a part of good, stealing something that was essential in the business. So when you have been robbed or when you have been stolen of something that belongs in the business, it is a loss. You cannot be calling it as an expense. You cannot be calling it as a liability. So theft by burglars becomes a loss in the business because you have lost a portion of asset that belongs to the business. So now that we have seen a few examples on how to classify, let us understand how the double entry system can be used, which recognizes that every transaction has two major aspects and you can record both the aspects of a given transaction. So under this system, every account is debited or credited based on the nature of account, which is asset, capital, expense, revenue, and liability that belongs in the business. Below is a sample illustration showing the various transactions. There are 12 of them specifically. I want you, the viewer, to pause this section now and carefully read each of the items mentioned below. In the next section, I will be showing how each of these items are accounted, the type of account, and which will be debited or credited. So every time a transaction pops up on the screen, you can just pause the screen to identify how I'm accounting the transaction, how I've identified the transaction, and how do I understand the debit and credit logic specifically. So to start off with, the first important transaction is Kumar started a business with rupees 60,000. So cash account debit rupees 60,000 to capital account credit rupees 60,000. Cash account is a real account, so hence all real accounts are debited in case of increase, and capital account is a personal account, so all capital items are credited in case of increase. So here both cash and capital are being introduced into the business. Cash by nature is an asset, so you debit in case of increase, which is in other words incoming to the business. And capital account by default is capital in nature, which is a personal account, so you credit it in case of increase, which is incoming into the business. And then you have the second item, which is purchased goods for cash of rupees 25,000. So the journal entry for this is purchases account rupees 25,000 to cash account rupees 25,000. So you have paid cash of rupees 25,000 and you have purchased probably some goods that you will be using in the business. So purchases account is a real account because purchase is part of an asset in the business, and cash account is an asset that is declining in the business. So by default, how are you going to understand this? You debit when there is an increase in asset in the business, so debit in case of incoming of asset, and you credit in case of outgoing of an asset in the business. So here you're converting one portion of an asset into another type of an asset. So you're converting cash to purchases which you will be using in the business. You have purchased goods which you're definitely going to use in your day-to-day operations or for manufacturing and production of further goods in the business. And then you have the third transaction, which speaks about sold goods for cash of rupees 25,000. So here the journal entry is cash account debit rupees 25,000 to sales account rupees 25,000. So cash account is a real account. So in here there is an income of cash. So cash is an asset. So you debit it. And to sales account rupees 25,000, because sales is where you're decreasing the asset in the business. So sales account is also a real account because sales is part of the assets in the business. So you credit it in case of outgoing. So in the previous transaction, if you look at the second one, you are having purchases, whereas here you're having sales. Both purchases and sales are conversion of assets in the business, but you're converting one asset into another asset. And then you have the fourth one, which is purchased goods from Mr. Zoltan for cash of rupees 10,000. So purchases account rupees 10,000 to cash account rupees 10,000. So purchases account is a real account because purchase, like I just stated, is an asset in the business, and cash account is also a real asset in the business. So it's a real account. So debit when there is an incoming of an asset in the business, and credit when there is an outgoing of asset in the business. So once again in the fourth entry, you are converting a portion of asset towards purchases. So you're converting cash into purchases in the form of goods. So in the fifth one, you can see that you have sold goods to Mr. Charlie rupees 8,000 on credit. So Charlie account debit rupees 8,000 to sales account rupees 8,000. So Charlie's account here is being debited because Charlie as a person is being identified as a debtor. A debtor is an asset to the business because they owe you money which they will repay in the future, and sales have increased in the business because you have just sold a portion of asset to Charlie. So both of these are assets here, but they are in different forms because Charlie as an account becomes a personal account, whereas sales is a real account. So you're converting an asset into a different form of an asset. So sales is being converted into a debtor. So debit the receiver and credit which is outgoing. So you're going to credit sales which is increasing in the business. And then for the sixth transaction, you have purchased furniture for rupees 6,000. So furniture is an asset. Furniture account debit rupees 6,000 to cash account credit rupees 6,000. So you're converting cash as an asset into furniture. So furniture as an account is a real account, so you have to debit it, but you have to credit cash account because you are converting one asset into another asset. So the nature of asset is debit when there is an increase or an incoming of asset in the business, and you credit it when there is an outgoing of an asset in the business. And then for the seventh transaction, you have paid rent rupees 1,500. So here it is clearly stated that you have paid rent. Rent is an expense, so all expenses have to be debited. So rent account debit rupees 1,500 to cash account rupees 1,500. So rent is an expense. An expense is a nominal account, so you debit when there is an increase in expense in the business. And cash as an asset is declining, so cash is a real account which is declining in the business, so you credit it because cash is outgoing in the business. And for the eighth one, you have paid wages rupees 500. So wages is also an expense, so the transaction is wages account debit rupees 500 to cash account credit rupees 500. Wages account is a nominal account because wages is an expense. All expenses and revenues are nominal accounts. But expenses, when they are increasing or when they have been paid in the business, you debit that particular expense. And cash is a real asset. It's a real account which is declining in the business. So hence you credit the cash account because there is an outgoing of cash from the business. For the ninth transaction, you have purchased goods from Ajay on credit rupees 5,000. So since you have purchased on credit from a particular person called Ajay, Ajay is the creditor here because he has lent you a portion of assets. So hence this is a credit purchase. So what you do here is you debit purchases rupees 5,000 because there is an incoming of asset in the business because purchase account is a real asset, and you credit Ajay account of rupees 5,000 because Ajay as a person is a creditor to you because credit is the giver. So in personal account, the one who is lending you money, the one who is lending you goods, or the one who is selling to you on credit becomes a personal account, and they become a creditor in the business to whom you have a liability. So Ajay here is a liability to you and you have to pay back that amount of rupees 5,000. Hence the accounting treatment is purchases account rupees 5,000 to Ajay's account rupees 5,000. So for the 10th one, we have dividend received rupees 1,000. So cash as an account has to be debited because you have received cash of rupees 1,000. So cash is a real account, and dividend is also a real account because dividend is also an asset that you can earn in the business. But here you're converting one form of an asset into another form. So dividend is being converted to cash. So hence cash is being debited of rupees 1,000 and dividend is being credited of rupees 1,000. So debit when there is an incoming of asset in the business, and you credit because there is an outgoing of asset in the business. But here you're converting dividend to cash. So cash is also a real account and dividend account is also a real account in the business. For the 11th one, we have sold machinery of rupees 1,000. Cash account rupees 1,000 has been debited and machinery rupees 1,000 has been credited. Both are assets in the business, both are real accounts in the business. So cash is being earned because you have sold a portion of asset which is machinery, which is also an asset. So you're converting machinery, an asset, into cash, which is also an asset. So both of these items are real accounts in the business. So hence you debit when there is an incoming of asset in the business and you credit when there is an outgoing of asset in the business. But in this case, you're converting machinery of rupees 1,000 to cash of rupees 1,000 by selling that machinery for cash. And for the 12th one and the last one, we have outstanding salaries rupees 2,000. So what you're going to do here is salaries account rupees 2,000 is being debited because nowhere it is mentioned that you have paid outstanding salaries. So salaries account debit rupees 2,000 to outstanding salaries account rupees 2,000. So salary account is a nominal account. So when there is an increase in expense or when there is an actual payment of expense, you debit the expense. But outstanding salaries is a liability, which means to say it has been outstanding for a long period of time which you are due to pay to your employees. So outstanding salary account becomes a personal account by default due to its nature of being a liability. So hence you debit the expense here and you credit the creditor here, who's nobody but your own employees in the business. So having solved a small illustration and understanding how transactions are recorded, we have to remember that all double entry system of recording transactions has dual aspect in its feature, which is nothing but assets at the end of the day, at the end of the accounting period, are always equal to the amount of capital plus liability which is there in the business. So this is a universal logic that you have to follow for double entry system. All accounting transactions henceforth will be following double entry system. Every single business that you look at in the world, they all follow the double entry system, which highlights assets are always equal to capital plus liability. In other words, whenever there is a debit in the business, there is always going to be a credit in the business. So this is the universal logic that you have to remember. Any transaction, there will always be debit. Any transaction, there will always be credit. So hence, that is why it is called as the double entry system. Hit the like button if you enjoyed the content. You can subscribe to my channel if you enjoyed this particular video. And you can always leave a comment, and all suggestions and ideas are appreciated. Thank you so much for watching this video. I will see you all in the next video.